All right, this is a bear put spread with a naked leg. It has three different options. It involves three different options. You're buying put A, your primary option, or your money maker. You're selling put B, just as you would do in a bear put spread. That's the first part of the trade. The third leg is a naked leg. And usually we choose to sell a call on a bear put spread. So making a bear put spread with a naked leg. When to use a trade like this is when you think the market will go down and the straight put option is very expensive and you want to be able to get a long put option with a closer strike price. The goal is to make the trade free or very low cost, or even a credit. Now the profit is limited to the difference between the strike price plus the premium collected for the call. At expiration, the break-even is equal to the long put strike price plus the net amount paid for the spread. Now, in a trade like this, there's several different calculations depending on whether it's a credit, debit, or even money trade where that break-even lies. And we'll try to show you all of that. Now, the risk is unlimited on the naked call leg. The market trading above the short call is equal to being short the futures from the call strike price, minus the net paid for the spread. Now at expiration, if the market is between the long put, your primary put, and your short call, you lose a net paid for the spread. Now before you do a trade like this, you need to understand the risks involved. So let's go over them. Okay, well look at that feeder cattle trade that we showed you in the bear put spread example. Now again, we're looking at the 114 and 111 bear put spread. And if you remember, it was about $500 or just over a penny in option premium that we netted out. So let's say that we don't want to spend that much money on the option, that we have a real strong feeling that this is the top and the market should go down or not up much further than it is. So in order to reduce the amount we're paying or the amount of participation by even more, we'll sell a call option above the market. In this case, we're going to look to sell a 118 call. Now, a 118 call is well above the current high, and as you can see, we can collect some hefty premium. That's because the market has been in an uptrend, and the implied volatility of the trade is extremely high. In other words, this option is way overvalued. As you can see, it's selling for way more than the put, the 114 put, even though the 114 put is closer to the money. This option is approximately 3.4 cents out of the money, and yet it's commanding more of a premium than a 114 put. That just shows you how the disparity in option premiums can really enhance your trading by taking advantage of excessive implied volatility. Okay, so in this case, we're buying a 114 put, we're selling a 111 put. Now this is our money making trade. This is one we're looking to make money on, this spread right here. We're selling a 118 call to collect premium to help pay for the bear put spread, as well as add a little extra premium, to collect. Now, the break even on a trade like this, once we get filled, let's get filled, and I'll show you where your break even lies. Okay, now on this trade, we collect, as you look over to the left, we collect a credit on the spread of $387.50. That moves our break-even. Now, this is very important. That gives us a reverse break-even, not below 114 as in the bear put spread example, but actually up at 118, just over 118.50. Well, 118.60, right about there, let's say. Okay, now, take notice of this. This is our reverse break-even. In other words, this is anywhere below this line right here, this trade will return a profit. Now remember, this is a very, very powerful tool in the fact that you've just twisted the odds of trading way into your favor. Remember, it's a 1 in 3 chance of making money in the markets blindly, because the market's either going to go up, down, or sideways. Now this is why we like this type of trade so much. If the market goes down, this trade will make money. If the market goes sideways being defined between this high right here, and this low, if the market goes sideways, strong chance of making money. If the market goes up, but not above the line above 118, where our reverse break even is, if the market goes up, we could still make money. Now, it's not a full 3 out of 3 chance of making money, but I'd say it's 2.75. This is a bear put spread with a naked leg. It's one of my favorite trading methods. Now watch what happens. We'll go 28 days in advance. Now the market goes sideways. Now during this sideways time period, we're actually making money. As you can see, the 118 put is losing a lot of its value. The 114 is maintaining most of its value, and the 111 is losing a lot of its value. So our two short options are losing value, making us money, while our primary option on 114 is holding on to, well, a lot of its value. Now we're only up $87.50 on the option trade, but that doesn't include the $325 that we collected, or $387 that we collected. Now remember, while I'm at it, this is a three-legged trade. There are 3 commissions on this trade. Let's go another 28 days in advance and see what happens. Now here's the difference. As the market drops, you can see that we're making money on the as the market's going down. Our call option at 118 has lost a great deal of its value, over 80% of it. We're making money on the 114. Now we're losing on the 111. However, we're still netting out on the option spread by itself $737 plus the $387 that we collected, giving us a total of $975 after $50 a trade commission. This is a bear put spread with a naked leg. Now the risk on the trade is above this line right here. If the market goes above our reverse break even, we have this line right here, we have theoretically unlimited risk. We'd have the same risk as if we were short the futures contract from that line, 118.67, I believe it was. The profit potential on the trade, again, is limited to the 3 cents or $1,500 plus the extra premium collected of $387. So in essence, you know, when this trade comes to, if the market is below 111 come expiration, just based on intrinsic value, we can make as much as $1,500 plus $387.50, or a total of $1,887. This is a bear put spread with a naked leg. It is a marginable trade. There's margin involved because of the naked leg. It's got limited risk, but it's a way of trading the market, you know, twisting the odds. Now remember, there is a substantial risk of loss in trading currencies, futures, and options, and that past performance is not indicative of future results. And before you do any short option trading, be sure you understand the risks involved.